What is going on, Internet? Eric Banos back again with another e-commerce conversations. I hope all is well on the other side of the internet. On the other side of the internet from me, Chris. What's up,
What's up, Eric? Howdy.
man? Look at us, a couple of international communicators.
That's right. I'm in Germany right now. You in Austin?
I'm in Austin, land of the hot, and Germany, land of the
Efficient?
well, yeah, the efficient. I was going to say like brats or sauerkraut or y'all have a
That's
lot of
also
things.
fine.
Beer,
Yeah.
the Autobahn. Yep, yep. Good to have you on here. I'm super excited for this chat. You don't know this right here, but I got a pair of
Oh,
Primos
look
right
at
here.
that.
Look at that. They have been well worn. They're definitely not just for show. I am a Koio customer, and you are the Koio founder. But why don't you give our listeners a quick rundown of who the heck you are and what the heck you did and what the heck you do now?
Sounds great. Yeah, I'm Chris Wichert, originally German, started my career in investment banking, then moved to the US for my Wharton MBA, which is where I met my co-founder. During that time, we decided it was a great idea to start a direct-to-consumer footwear brand during the hype of the DTC market in 2015. So we moved to New York post-Wharton with the goal of building the first DTC luxury brand around footwear and got started. Raised some money and started building the brand as an omni-channel brand across DTC, retail, and wholesale. Did this for 10 years, then exited the brand. Yeah, 6 months ago, stayed on board to integrate the company with the bigger portfolio of the buyer, and now I'm advising other consumer brand founders on how to get to profitability, how to stay there, how to manage an exit process, and to general like strategy.
There's a lot to unwind with that. That's a that's a
Yeah.
10 years of business. We're gonna unwind that a little bit. Coming from the MBA school, like let's talk first about Koyo, and you decided to raise money. I would imagine this is a pretty capital intensive business, a ton of SKUs when you're dealing with sizing for shoes and a relatively high price point product. Was that always the decision from the get go to raise money?
It really was. And the reason for that being one, business driven, because it's a relatively capital intense business, especially at the higher price points. But also B, because we were both coming out of business school with business school debt, and we were building this business in New York, and that was our only way to survive.
Yeah. Well, let's dig into that too. So you're German, you're in New York. How long does it take to acclimate to the American style of business?
Not that long, actually. To be fair, as a kid, I was traveling the US quite a bit. Most summers, my parents took me to the US, all over the US, really. And then I had a semester abroad already in high school, where I was in Minnesota, and I had a semester abroad in college as well, where I was in LA. And then with Wharton, kind of that was the last transition piece that I needed.
Yeah. What were your parents doing that they brought you to America so regularly?
They were big fans. They really loved spending time in Florida, in California, showed us the countryside, like really were in love with this country and wanted to bring us here. They had some distant relatives in the US and wanted us to experience the American culture.
Yeah. Do you feel, how do you feel? I mean, how long have you been in the States? Are you still in the States or did you move back to Germany or?
No, I'm still living in New York. I
Okay.
moved to Brooklyn by now.
Do you feel more American or more German at this point?
It's a good question. It's like it's a weird mix. Like I feel like I speak neither language good anymore, and I'm sometimes certain things I can only say in English, typically the business things, and other things I can only still say in German. It's a weird mix.
Yeah, one of my good friends, Tobias Van Schneider. I don't know if you know him or not. He was a designer at Spotify. I think he grew up in Austria, um, or maybe a little bit of Germany as well. And I think there's like seeing Europeans come to America and going after like the American spirit and creating your own business and going that pathway. I would imagine it would be pretty challenging to head back to Germany and like deal with the bureaucracy if you were to start a business back in Germany and in that aspect?
Y- Yeah, also a good point. Like I'm playing with the idea a lot. Like now my fiance, she's actually Lebanese, and she's fully settled in New York. That kind of makes it harder. I keep trying to push her a little bit by alluding to the idea of us moving to Germany. She doesn't like it very much, but I'm also realizing that I'm not fully sure of like how much I would like it. I feel like I underestimated like living in New York where you have everything at all times that you want, access to the best people. It's a super fast paced environment with little bureaucracy. Feel like I'd probably miss it. But at the same time, I think Germany also has like many, many beautiful sites. And things that are in its favor, right? A much lower cost of living, a very high quality standard of living. Yeah.
Cool. Well, let's go back to raising the money. Like, you're in business school. Does the Wharton School like line you up with a lot of people with money to help you get started, or how were you able to raise your capital?
Yeah, we didn't raise it during business school. We actually moved to New York right after. And we told ourselves, hey, listen, let's give each other 6 months, see if we can figure this out and start the brand properly, or we'll move back to Germany. Um, the Wharton School connections were like conversation starters at the time. Some people started in VC, some people could introduce you, but they didn't really line you up for capital. And then, of course, like the 6 months goal of raising capital was pushed many times. You have these little moments of success, like features in magazines or more customer orders than you think, or great customer reviews that keep you going and keep you pushing. And then ultimately around like month 12, we had like a financing round lined up. Initially, we raised 1.5 million, and that kind of got us started. But it also kind of set us up for probably the wrong path compared to the business that we were building. Because on the one hand side, building a luxury DTC brand with a high AOV requires patience and brand building, right? You really need to keep investing in the brand over and over again, and you are going to see the compounding effects of that starting after 5, 6, 7 years. And you need to be patient. And when you invite foreign capital into your cap table, especially when it's VC money, you're signing up for meeting certain expectations that are not aligned with building a brand necessarily super sustainably.
Yeah, so you raise 1.5 million. That money, does that go to inventory? Does it go to marketing? Where do you allocate those resources, and where
Well,
they?
initially we raised 1.5 million. Over the course of the 10 years, we raised close to 20 million. And there was a mix of like raising money from VCs like Founders Fund, family offices like the Winklevoss and Aldo, and also like bringing on board like some other DTC entrepreneurs. Where does the money go? Initially, of course, funding your inventory, getting your first hires on board. Our first hire was an ops person. Our second hire was a marketing person. And then one thing that we learned early on was for a $300 shoe that doesn't have a brand behind it, where you need to build the brand, a lot of investment has to go into building that credibility layer. So we invested in PR early on, and we also invested in testing pop-up stores and retail early on. We saw that as soon as people saw our shoes in person, felt the leather, like saw the shoes on their feet, they liked it a lot better, and the conversion numbers were a lot better. So we early on went into retail and digital as like a dual strategy.
And you feel like that was the most effective um, avenue for growth and awareness, was through those retail and physical avenues?
I think for us, it really worked. We were lucky with our location in Soho on Broome and Lafayette that is still there, where like it was a perfect mix of attracting our target customer. It had a good throughput of tourists where there were constantly new people that had money to spend. And it also served as like a billboard. We later tried different store formats. Unfortunately, many of those overlap with the pandemic. So it's hard to say if like other locations worked as well, but certainly there was something about this location. But in general, I think like the not just being D2C is generally a good strategy, especially as you're growing the business and you don't want to be overly relying on just like one channel, where you're heavily dependent on like your customer acquisition costs that are directly set and determined by Meta and Google.
Yeah. Now with having, I don't know how your capital raises were, if they're like gradually over time or if they're all kind of like one or two rounds. But I would imagine when you get a big chunk of cash in the bank account, it causes you to maybe misallocate resources and invest in things that were not ideal. Was that something that you guys faced, and any lessons learned in that?
Yeah, absolutely. I feel like generally, like you're thinking a little bit more about how to spend that money and like finding ways to justify the raise. Um, and I feel like a lot of this could have worked if it weren't for two big changes along the way that kind of like changed our trajectory. I feel like for the first 5 years up until 2020, things were going pretty smoothly and seamlessly. We were seeing great growth that justified the raises. But with the pandemic, well, our retail business was wiped out overnight, and we had 4 or 5 stores at the time. Plus, the use case for our shoes was also kind of gone. Like our shoes are dress sneakers that you wear for occasions where you meet other people. If you go on a nice date, if you go to work meetings, if you go to a wedding, for example, and all of these social occasions were wiped out, and you wouldn't wear these shoes just for lounging on your couch. So that was complication number one. And then complication number two, as we figured it out, was in like late 2022, early 2023, kind of the collapse of the hype of the DTC market, where all funding evaporated, valuations just plummeted from one day to another, and everybody who wanted to be in DTC didn't want to be in DTC anymore. So that forced us to really look at where we are as a business, how sustainable we are, and like decide on some pretty significant changes in order to make sure that our business is profitable and sustainable.
So, like, kind of up to 2022, you guys were um, focused more on growth than profitability. And in 2022, you had to come in with a scalpel and make sure that the business was going to remain profitable. Is that effectively how I'm hearing it correctly?
Yeah, absolutely.
Okay. And then, so like from 2022 on, were you still raising money, or have all the raises been done by that point?
So our biggest raise was in 2019. That was our A round for almost $10 million. And we used a lot of that money to open retail stores. Great timing. And then after that, the only raises that we did were like internal rounds by our investors that really believed in us, that saw how we were trying to turn the business around, that were like funding us to turn the business around.
And so in 2022, what were the big changes that you had to do to make the business sustainable?
So yeah, at that time, again, we looked at the business and we were seeing that we were losing roughly $3 million per year, and the growth was gone. Plus, we had an organization that was way too complex and way too costly for where we were as a business. You kind of like build the organization always for the next year, right? So that you grow into the revenue, but then if that revenue growth is not coming, you're kind of struggling. So what we did was we identified like, what is Koio really about and why do customers come to the business? So the first step was interviewing 100+ customers to become really customer centric. And we learned that our SKU proliferation over the last years, expanding from men's dress sneakers into boots, loafers, slip-ons, all sorts of shoes across men and women, was detrimental to the brand. All of a sudden, our messaging wasn't as clear anymore. All of a sudden, we had so many different products that we were advertising, and nobody knew what Koyo stood for. So decision number one was like, cut the SKU proliferation and go back to the core. Decision number two was right-sizing the organization. And that meant, well, letting go of a lot of people that were very dear to us and that had worked with us for a long time. We probably cut 60 to 70% of our New York team. We moved the organization to remote. We closed the office. We also closed unprofitable channels, such as certain dropship accounts and stores that weren't driving a profitable revenue. And then we started rehiring internationally, remotely for certain roles. So over the next 12 to 18 months, we were really trying to rebalance the company with a much leaner organization, trying not to dip in revenue. And luckily, we were successful in that. So when we did that switch, we kept top line stable, and cut a lot of the cost out. And one big surprise in that was like, especially going through all your software tools. I'm sure a lot of people hate me for saying that right now, but like we had 100+ subscriptions to SaaS tools, and we cut through a bunch of them, and I renegotiated every single one of the ones that stayed on board. And we didn't see like a negative effect from that at all. Quite the opposite. We were a lot less complex, a lot more focused, and things felt a lot smoother.
What did that renegotiation look like? Like, could you renegotiate with Shopify, the big players, or
With Shopify, we've always had a really good relationship through one of our investors. So we were already on their lowest plan. But we certainly tried. And the answer there was, you're already on our best plan. And it's kind of very, very key and core to the business. So you can't do much there. But like we mapped out all the software tools that we were using, all the different vendors that had been added over time. And you'd be surprised. There were like 20 or so that no one was using anymore, that were just like costing you $500 a month. And then for the others, we'd be like, I'd be like, let's cancel it. And a lot of people would come back to you and be like, oh, no, stay. I'll offer you a better price. And then for the others that you really wanted, you would be like trying to talk to the founder or someone you trusted in the organization directly and make your case for why you should be paying less. But it was like tedious work, not very glamorous, like really messaging them one by one.
yeah, I think that's one of the things that we've implemented is we're using Mercury as our bank right now, and we can basically create credit cards on the fly for any particular software tool. So you can create a credit card specifically for a software tool, and then you can just go through it really quickly and cancel those cards without having the negotiation or like like some of these companies make it very difficult or annoying to unsubscribe from their plan.
For sure.
So this, or the other thing is like tying a subscription to an employee. So like an employee will have that subscription kind of be responsible for it. And then if you have to let that employee go, then you also automatically kind of cancel their subscriptions too. So you don't end up with these, like ghost software tools that nobody knows why we have it or how to log in, all that stuff. It's crazy. It does not surprise me at all because we went through that same thing. And it was like, I don't care if it's $10 a month, like we're cutting it because there's
Exactly. It all adds up, right?
yeah, it compounds. All right.
And
So
sorry,
go
just
ahead.
one last thought on that, because I think that's very, very important. It's like typically a lot of these vendors try to lock you in for long periods. One thing that we also did in the renegotiation was like month to month or 3 months contracts, which is something that the software vendors hate. But right now, especially with AI, we're going through a phase where things are changing so quickly. So many software solutions become redundant, and you truly don't know what the world will look like from a vendor perspective in like 6, 12, or 18 months. So it doesn't make sense to let yourself be locked in for a long period. And I think that's one thing to look out for right now when you're negotiating these.
I'll echo that. That for us is a red flag when dealing with any partners. We've had plenty of agencies who we've worked with who have been from the get-go month to month. If you can't, if they don't feel confident enough in their products and their services, I understand there's risk associated with that, but there's risk on our end for it as well. We've been able to exist at Beard Brand. We've been able to exist for 14 years without signing any kind of significantly long term. I want to say any because we've learned our lessons. Like we've certainly signed long term contracts that were not fruitful for us and that we needed to get out of as well. But it's possible to get into those contracts or look for alternatives. Generally speaking, and avoid those. So I would echo that with 100% certainty that that's a good strategic decision. Now, you made all these cuts, rebuilt the team to remote. Are you guys profitable at that point?
Yeah, we were break even profitable. And then the question was, what's next, right? We had been at this business for 8 to 9 years, probably 8 years at that time. And we also realized because of all the money we raised early on, we're now in the situation where we felt like we had an obligation towards our investors to like, and also us and each other and our employees to end this on the best possible note. At the same time, we weren't like perfectly incentivized anymore, right? We were heavily diluted. We had lick prefs stacked up against us. But we were very, very driven by the idea of finding a positive outcome for everyone involved. So as the next step, I set out to try to create our exit. And the first step of that was connecting with a lot of people in DTC, especially footwear brands and generally other apparel and accessory brands, and evaluating the idea of a merger because there's still, I think, it still makes sense to think about this platform idea where you're combining a bunch of brands that have potential revenue and cost synergies and you build like a brand universe, right? So we tried to do this on our own for a little bit, but realized that both of us didn't want to keep running this business. We kind of needed to bring this to a clear end, a clear cut after all this time and have a full reset. So we pivoted to a full exit. That process was quite cumbersome. Given that there's not really many helpful bankers in the space, especially not at that size or right now in direct to consumer where there's very little deal activity, especially from strategics. So I needed to create our own luck essentially by just reaching out to people, having conversations and pitching them our brand. And it took almost 2 years, but we got a competitive process going and talked to a bunch of parties that were interested in the company. And then, one complication was the tariffs last year, Liberation Day. That was around the time when we were hoping to close. It completely derailed our conversations because a lot of the people that we spoke to had massive China exposure and were like, well, we have way bigger fish to fry right now. But ultimately, we found a partner that we trusted, a small strategic, and we closed the deal with him in August of last year.
So I want to dig a little bit more into that. So this whole process, were you listed at all with any brokers?
No, we didn't go through brokers. I was
so
speaking
you're just cold calling, cold email. You're on LinkedIn looking for people in M&A at strategic companies.
I was speaking to bankers in the space. I was speaking to my network. I was expanding my network, and everyone was probably helpful with like 1 or 2 introductions. And then we had a big investor base over the course of the years. We had probably 70 people on our cap table. So each one of them was also helpful. And I was just trying to be as resourceful as possible and like getting introductions lined up, speaking to as many people as possible, and getting a process going.
Were you public with your employees during this process? Were you like, hey, we're selling the company?
Good question. I think we were public that in the terms of like that we're looking at a bigger strategic change for the company. And initially, we weren't even sure where it was headed, whether it was going to be a merger or a sale, right? But we didn't tell them, hey, in 2 months, we're planning to sell the company. But we were telling them that we were looking for a partner that could help us transform the business.
Okay. So they were aware that, you were having conversations, you were doing meetings. It wasn't How big was the team at this time? Was it
At the time, we were in New York, less than 10 people. And then we
okay?
had a bunch of freelancers and like 4 or 5 people remotely.
Yeah, I always wonder like that part of the process. Like, how transparent do you want to be with your team? You know, does that affect their performance? Do they start getting all nervous? Do they start looking for new jobs? They, you know, quit on you?
So here's the thing. I think we were in a unique situation given that a lot of the people that were still with us in New York stayed on post restructuring. I think that's generally one thing that I was proud of, that like the people that we didn't let go in our restructuring, we could motivate them to stay on board and work with us because, well, I feel like they learned a lot during this time because they were promoted, took on additional responsibilities, but it also showed trust, right? We had a very close relationship and we were figuring this out together now. We went from like a 30-person team to a less than 10 people team. And so we felt like we could be honest with them to a degree. At the same time, I think you want to manage, yeah, these concerns openly, right? That they might have, because the worst thing that could happen to you is you're trying to run a process, you're already spread super thin, and then the 4 people that you have left in the company are also looking for a new job, and you have no one like keeping the business afloat.
Yeah. So let's dig into the deal flow a little bit. So these are all introductions. Like, were you able to, you know, I think you get the best valuation when you have a couple companies competing against each other. Were you able, I think you alluded to that a little bit, you were able to create a competitive environment for the company, or
Yeah, absolutely.
how were you
And that,
able to do that?
I think, yeah, I mean, it happened because there was interest from different parties, right? I think you
Yeah.
need to be very strategic in terms of like, hey, now I'm going out, and this is the message that I'm giving to people. Keep them to a tight timeline. Don't run an open-ended process. And as soon as you have parties in there, let them feel the competitive dynamic a little bit, right? And try to drive to a joint timeline and a joint outcome. Yeah.
Would you, you know, kind of have these conversations and be like, hey, in you know November we are going to put not the product, the company available to bid on. So if you're interested, da 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 da, and then that would give you time to kind of work a few different people to let them know that on November, or was it like, hey, the company's available now, let me know if you're interested, and then you're doing this constantly?
No, you need to really prepare your exit, right? If you have the idea that you want to exit and just start exiting now, that's a terrible idea. You're gonna get the best deals and valuations if you have relationships with potential buyers. So, like a lot of the legwork going into this was networking, was being on the radar for these companies that you were talking to and making sure that you had options. So that was the legwork that was happening. And then at a certain point, for us, that was like right before the end of the year and 2024, we were like, okay, now we have like interested parties. Let's run a process. Let's like put the data room together, give them access to the data room, ask for LOIs by a certain time.
Okay. And then who are these contacts? Are they other founders? Are they CEOs? Are they people like in a division within a larger corporation? Like, who are the contacts that people should be trying to develop relationships with?
I would say, well, start by thinking through is your most likely buyer. Who's your buyer? Are they active right now? Are you like being realistic with that? Right? I feel like for a lot of DTC brands right now, the buyer, the exit doesn't exist, right? Like strategic footwear brands are not interested in like, yeah, in like, let's call it like $20 million brands that are looking to exit. They're looking for much bigger opportunities so that the juice is worth the squeeze, because it is a lot of work, like evaluating an opportunity, getting it done, integrating it into your business, and making it part of the thesis. So right now, I think in the direct to consumer space, if you're like sub $50 million, sub 5 million in EBITDA, you have limited options and you need to be creative. And those options could be aggregators. Those options could be other direct to consumer brands that might have a gap in the product offering that you're offering, or there's a great fit in terms of brand story. But you're less likely to find private equity investors at that size, and you're less likely to find bigger strategics to be interested in you. The other option would be family offices, and those information of family offices are typically like very private. So those require especially a lot of networking in order to build these relationships.
Okay. Are you able to say what kind of partner that you or who you sold to? Or
Yeah, we sold to a small strategic based in Miami. He had already acquired a few other brands in the footwear space, in the underwear space, and he is building a platform across of these brands. Koio is by far the biggest company in his umbrella, and it's kind of like the flagship brand. And yeah, in the last months that I stayed on board, we helped him like integrate the Koyo brand into the overall brand portfolio and make sure that the workflows are aligned for accommodating that many brands.
yeah. So what does that transition look like? It was only a 6 month time frame that you guys stayed on.
Yeah, it was only a 6 months time frame. We wanted this to not drag on for forever. Both my co-founder and I remain shareholders in the business to a degree, and yeah, we believe in building this brand platform. But we wanted to make sure that the most important operational levers are pulled. Right, there needs to be some sort of consistency in terms of brand voice. There needs to be some consistency in terms of product portfolio. So we wanted to help working on that. And then we also wanted to make sure that like, yeah, the Koyo employees and the Koyo brand was integrated into each of the workflows. Right now, there's like one customer service team that handles all brands. There's one back office team that handles all brands. And those structures need to be created. It was very different to what it was before, and that requires a bit of like, yeah, restructuring it, training your people to get used to it.
Okay. So you've been on the grind for 10 years. I would imagine you're a bit burnt out. You finally sold the company. You've helped with that transition. Do you, during this period, do you know what you want to do next? Obviously, you're working on the next thing. Was this something you were prepared to do, or is this going to be like something to allow you to rekindle the next thing?
Yeah, great question. I feel like in the last year of Koyo, I was like, the grass is always greener on the other side, and you see the hype in other areas, particularly AI, and you feel like you're missing out and you want to be part of that conversation and you can't wait to get there. So the first thing that I did naturally was like get an expert at AI, even in the last years of Koyo, and like evaluate opportunities as a founder at the intersection of AI and e-commerce. But I quickly realized that I might be driving myself crazy and not be properly accounting for the fact that I had run a brand for over 10 years, and that like requires a little bit of time to reflect and like digest before you like start another company, A. And B, like the other big realization that I had was like, there's so much going on in AI right now on all different fronts. It feels like 10 times more extreme than the early hype in DTC in 2014, 2015. And my guess is that in a few years from now, there will also be some big winners, but a lot of losers, right? There will probably be 80 or 90% of the funded startups that are not going to be make it, that are going to be replaced by other bigger competitors, replaced by Claude or Chat. So it's just as risky. And I felt like right now I've built a great network in consumer. I love working in consumer, and I have all this knowledge and experience that I'm happy to share and like want to keep compounding on. So I feel pretty set on staying in the consumer world. Right now I'm talking to and working with a bunch of founders across different categories in consumer, whether it's skincare, whether it's footwear, eyewear, watches, you name it. And I'm seeing that a lot of the lessons that I learned are very applicable to their situations as well. And I think that's great knowledge. And right now I'm building on that.
Yeah, I think there's I don't know who said it. I'm going to quote Warren Buffett. I don't know if he actually said this or not, but it was basically an idiot doesn't learn from their mistakes. A smart man learns from their mistakes, and a genius learns from the mistakes of others. And I think, as you kind of alluded, you talked about a little bit, is, finding somebody who's gone through and done something. You were talking about doing that with AI, but the same is true with business, is being able to connect with other entrepreneurs who have been there, who have done that. I mean, you've gone through the full gauntlet of entrepreneurship. Like, you've raised money, you've lost money, you've made a profitable company, you've sold, and you did it what I would imagine to be a harder way. Like selling your business through networking versus working through brokers seems like a much more challenging way to do it. Like, you're doing it on your own. You're blazing your own pathway. I would imagine there's a lot of lessons built in there. Who would be like an ideal person to work with you? Like, what size business? What are they going through?
Right now, I'm mostly working with companies that are doing between 5 and 50 million in revenue. Consumer brand founders, either on the strategic side, like figuring out what their priorities should be, trying to make the right decisions, allocate capital correctly, or people that need help to analyze their P&L and get to profitability and find ways to stay there. And then I think third part would be operations, right? Like figuring out your new 3PL partner, figuring out what's the best way to run the supply chain, what's the best way to manage your customer service. And then last but not least, if you want to chat about your exit, what it takes to get ready for an exit, what buyers are looking for, how to make sure that you're driving towards these numbers, and how to begin having these conversations.
Well, Koio is a beautiful brand. If you guys have not seen them or heard of them before, I recommend you check out the website. It's incredible what you've done. The products are incredible. Long-time customer. I appreciate you coming on the podcast and sharing your journey and what you're up to. I hope our listeners enjoyed it as much as I have. Thanks for everything. Cheers.
Thank you, Eric.
Keep on growing.